On June 25th, 2026, Apple did something it had never done before. Right in the middle of the year, without launching a single new product, they suddenly raised their prices. The MacBook Air jumped by 18%. The iPad Pro went up 20%. The Apple TV spiked 54%. Even Microsoft bumped up the Xbox by $150 in the exact same week. When asked why, Apple admitted they had never seen component costs rise this much this quickly. The reason your laptop just got more expensive is because of a bidding war over tiny memory chips happening thousands of miles away, inside facilities like this. These industrial warehouses are AI data centers. Before ChatGPT even existed, Amazon, Meta, Google, and Microsoft spent a combined $90 billion a year on infrastructure. By 2026, that number exploded to $725 billion. That is an eightfold increase in just 6 years. This invisible $725 billion spending spree is why everyday electronics are suddenly getting more expensive. But to understand why tech giants are hoarding so much hardware, we have to look at the massive hole in their accounting. Right now, Wall Street analysts are staring at a massive financial mystery. They call it the $600 billion question, and it reveals a critical flaw in the AI industry's business model. This scale visualizes the math of a viable investment. If you're sinking money into a risky new technology, you expect at least a 10% return. JP Morgan ran the numbers and found that to justify spending $725 billion on data centers, the AI industry mathematically needs to bring in $650 billion in revenue every single year. But when you add up the actual earnings of OpenAI, Anthropic, Gemini, and every other major AI model combined, they are only making about $75 billion. For every dollar the industry earns, the tech giants are spending 9 to 10 times more. The entire financial structure of this boom was built on a single assumption, that corporate enterprises would endlessly pay expensive subscription fees for AI software. But that assumption is currently failing. According to McKinsey, 73% of enterprise AI deployments are failing to achieve their projected return on investment. MIT puts that same failure rate even higher, at 95%. Executives are buying these tools and realizing they can't actually measure any financial return. The business model of the AI boom relies on infinite corporate software subscriptions to cover massive physical infrastructure costs, and the math simply isn't adding up. We are already seeing the pullback. The chief technology officer of Uber admitted they blew through their entire annual AI budget in just 4 months. Startups are abandoning flagship models entirely, abruptly switching their traffic to cheaper alternatives just to cut costs by 90%. And the CEO of Palantir issued a stark warning, stating that clients are realizing these expensive AI tokens create zero value for their businesses. Desperate to process data faster and justify their massive investments, these data centers have started aggressively buying up a specific, highly expensive component: high bandwidth memory chips. Capital always flows to the highest bidder. So global manufacturers like Samsung and Micron looked at the AI data centers paying 10 times more for memory and suddenly shifted 93% of their entire factory production away from consumer chips and directly toward AI hardware. When 93% of the world's memory manufacturing suddenly pivots to server farms, regular laptop and smartphone chips become incredibly scarce. The contract price for PC memory more than doubled in a single quarter, and the cost of 1 gigabyte of standard RAM shot up by over 500% in just 6 months. Big tech hijacked the global silicon supply chain to feed a failing software model. And because they did, everyday consumers are forced to cover the difference through an involuntary AI tax every time they buy a device. This diagram illustrates an economic framework known as the capital cycle. It explains why giants like Microsoft and Google are willing to burn billions of dollars despite horrific short-term returns. The cycle always goes like this. High returns attract massive capital. Capital keeps flowing until overcapacity is built. Overcapacity leads to a collapse, and a few survivors buy up the wreckage for pennies to eventually make a fortune. We have seen this pattern play out before. After the 1996 Telecommunications Act, the internet was exploding, and investors poured $500 billion into laying fiber optic cables across the country, convinced bandwidth demand would grow infinitely. They built massive overcapacity. Telecommunications companies buried millions of miles of cable underground, but internet traffic didn't grow fast enough to fill it. By the early 2000s, 97% of that installed fiber sat completely unused. Without actual paying customers to cover the cost of the infrastructure, the collapse was inevitable. Bandwidth prices plummeted by 90%. The ensuing crash wiped out $2 trillion in market value, bankrupting corporate giants like Global Crossing and WorldCom. The technology itself was real. The internet did change the world, and those cables eventually became the backbone of Netflix and Google. But the speculative price investors paid to build it was wrong. Today, the AI industry is repeating this exact historical mistake, just at 10 times the scale. The AI industry has now reached the tipping point of this capital cycle, which leaves us with only two possible paths forward. Path 1 is that the overcapacity results in a collapse. The bubble pops violently, triggering a broader tech stock crash. Every major company slams the brakes on infrastructure spending, and the resulting shockwave causes widespread job losses across the entire tech and service sectors. Path 2 is that the companies refuse to let the bubble pop. To avoid a crash and justify their trillion-dollar valuations, the tech giants artificially skyrocket the price of their software. The cheap AI tools you use today become prohibitively expensive, turning from everyday utilities into exclusive corporate luxuries. Whether the market finally corrects itself or the software costs surge to match the hardware deficit, the conclusion is exactly the same. The brief era of heavily subsidized, cheap artificial intelligence and affordable consumer technology is permanently over.